Hello and welcome. We're going to give everybody just another minute or two to get on the line, and then we're going to go ahead and get started. So if you're on the line, just go ahead and take a minute. Might want to grab a piece of paper and a pencil to grab some notes as we go through this information. But we're going to go ahead and get started here in just a little under 1 minute. Hello and welcome everybody. We're going to go ahead and get started at this time. I'd like to welcome everybody for joining us today. Today's webinar is going to be on the 3 hidden secrets that your tax return reveals and when selling your business and what you can do about them. I'm Kimberly Deese and I'm with Murphy Business and Financial Services of North Florida. We are specialists in the sale and transfer of small and medium-sized businesses. Today's webinar is being recorded and we will be sharing it with all participants that have registered for the event. If you have any questions during the webinar, please type them in the chat box and I'll be glad to answer them at the end of the webinar. Or you can feel free to email me at jacksbizbroker@murphybusiness.com. So let's start by looking at a typical sale. Tom had thought long and hard about selling his small manufacturing business, a business he had once loved, but he now felt stressed about going to work. The employees were harder and harder to deal with. His customers were becoming way too demanding, and he felt like he was just burnt out. He knew it was getting time to sell the business. Thinking he was being savvy, he tried to sell the business on his own. He figured he learned how to run his business. Certainly he could learn how to sell it. It can't be that hard. Little did he know the high price he would end up paying by doing it all by himself with no guidance. Tom had heard manufacturing companies sell for 3 times the net profit, but he knew there was more profit that wasn't showing on the tax return. He had lots of owner perks. He had the box seats at the football games. He had the vacation house, the symphony, the annual symphony passes. His son was on the payroll but wasn't working in the business. And there were lots of other items that from time to time he put into his books. After finding a website, he posted the business for sale and with his phone number, and boy did the buyers start calling. All times of day and night, and they demanded an instant response. He was quickly overwhelmed. He didn't expect that. Not only was he working his normal 40, 50-hour week, but now he felt like he had a second full-time job to his buyers. What had he gotten himself into? It was an endless list of the same questions being asked over and over and over again. He spent so much time focusing on the buyers that the sales started to decline. He couldn't focus on running the business and managing all the buyers. He was getting frustrated and even more burnt out. And because his phone number was published, his manager found out about the sale and promised not to tell others. But Tom knew better. He doubted that would really happen since they loved to talk about anything gossipy on the production floor. Finally, he found a serious buyer, and after answering all the questions, giving him all the tax returns, the buyer was very skeptical. And Tom thought, could this buyer not see what a gem this business was and how much money I'm taking out of it? But the buyer had a different perspective. The buyer offered him 35% less than he thought the business was worth with a large seller note. Tom was highly offended, but the buyer explained the tax returns couldn't support his price, and the business was far too risky to pay what he was asking for in all cash. Tom was crushed. This was his one chance to sell the business. If he had only known the secrets that his tax return was revealing, he could have avoided all of this. So today, I'm going to reveal the secrets that your tax returns are hiding. But before we explore these secrets, let's examine why tax returns are so important in the sale of a business. See, when buying a business, tax returns are the most trusted information. The primary reason is that the tax returns are legal documents that are filed with the federal government, and there are severe penalties for being inaccurate or fraudulent. This often includes imprisonment. And even the accountant can be held legally responsible if the tax return is not accurate, and they can be fined tens of thousands of dollars for signing a false return and even lose their license. This is pretty serious stuff if the tax returns are found to be inaccurate. These heavy penalties give buyers a sense of confidence that what is stated on the tax returns are more likely to be accurate than any other document, and hence the buyer has more confidence in the tax returns than any other document. And the reason a buyer needs a sense of confidence in the financials is that what a buyer is really buying is more than the value of the stuff. So let's take a small dry cleaning plant, for example. Let's say the value of the hard assets, or the things that you can touch, the stuff, is $4,000 for the furniture, maybe $1,000 for the fixtures, say $30,000 in equipment, and maybe they have about $1,000 in inventory like soap and bags and stuff like that. Well, if the selling price is $236,000 and they only have $36,000 of stuff, what is the buyer really paying the extra $200,000 for? And see, the answer is goodwill. Goodwill is the intangible items of a business, the customer list, the good name, the website, and all the other items. Since the value of a business, in many businesses, is calculated based on the multiple of the net profit from the financials, a buyer wants to make certain, with no doubt, every number on those financials are accurate and there's no funny stuff going on. He wants to make sure that all the sales are 100% accurate. Is this really the sales from this business? He wants to make sure all the expenses are not underreported. He wants to make sure everything makes sense, so he digs deep. So as the buyer is reviewing your tax returns to confirm all the data is accurate, he will discover certain secrets that are hiding in your tax return that most business owners might not even know about. So over the next 20 minutes, I'm going to reveal 3 secrets that your tax returns are hiding and how you can address each one to make sure it does not kill your chances of selling your business or drastically decrease the value of your business. So if you have a pen and paper, now's a great time to grab some notes. So let's get started with secret number 1. Secret number 1 is your tax return reveals how healthy your business is. There are many ways to determine the health of a business. It starts with the front page of your business tax return, where it shows your net profit for the year. This is one indicator of health. Is the business making any money this year? But there are more indicators. As you flip through the tax returns, many returns will have a 2- and 3-year P&L comparison, a profit and loss comparison. This tells buyers how you've been doing over the past years. This is another indicator of health. Are the sales increasing, decreasing, or flat? Is your profit increasing, decreasing, or flat? How are your expenses tracking? These comparisons provide a detailed year-over-year insight into the operations of your business. So when the buyer's CPA reviews your taxes, they might see that your numbers aren't matching what one might expect for a business like yours. These are called benchmarks. For example, in a restaurant, it is expected that the cost of food ranges somewhere between 28 and 35%. Now it depends on the type of restaurant. Obviously a breakfast and lunch is a little lower on that end, and a barbecue and steak place are a little bit higher. Now if you owned a restaurant, the tax return showed a cost of goods for foods that are 50%. You are either a very bad operator or you have a thief in the business. Now this could be employees stealing from the business or the owner. Either way, something's not right in the health of this business, and the tax returns are going to reveal it. We once analyzed a restaurant and found somebody was stealing $75,000 in liquor sales. Now we don't know who. Could have been the bar manager, bartender, or the owner, but the numbers were off by $45,000. See, a good broker and accountant is going to reveal this secret. They're going to analyze this data, and you want to know about it before any buyer ever sees your financials. Give yourself a chance to correct anything that may be truly an honest mistake. Almost all industries have benchmarks, and when your business is way off from these benchmarks, it is easy to spot dishonest reporting and an unhealthy business. But the health of your business is more than just your profit and loss statements in the tax return. There's also the balance sheet in your tax return. This is Schedule L. Your balance sheet shows your assets and liabilities. Your assets are things like inventory, equipment, deposits, accounts receivable, depreciation, and much more. This is all the stuff you've accumulated over the years. Your type of business will determine what items are actually shown here. The other half of the balance sheet shows your liabilities, such as loans, accounts payable, current liabilities, and long-term liabilities. The difference between the assets and the liabilities is often called the net worth. Now, this is not the value of the business, but simply a calculation of what the business owns compared to what the business owes. A business that has high liabilities may have a health issue, indicating a reason for the high liabilities. Think of the balance sheet like a doctor using a stethoscope to listen to your heart. Just as a doctor can tell a lot about your overall health from your heartbeat, so can a buyer, usually with the help of an accountant, tell a lot about the health of your business from your balance sheet within your tax returns. Now, one specific part of the balance sheet that has secrets it can tell is the inventory. If you are a service business, you may not have any inventory, so this may not apply to you. But the businesses that do have inventory, you'll want to listen up. An accountant and banker will start looking at ratios involving your inventory to see how efficient your business runs. This specific ratio I'm referring to is called the number of turns. The number of turns is a calculation of the cost of goods divided by the inventory. Now, say your cost of goods is $100,000 and you have inventory of $20,000. This would indicate a turn ratio of 5. This number indicates how many times you turn your inventory per year. So for this business, they purchase new inventory about 5 times a year, and that's their turn ratio. Each industry has different turn numbers that are acceptable. For a restaurant, we expect this to be about 50 or so. We know this because most restaurants order weekly. That means they turn their inventory 50 to 52 times per year. A manufacturing plant might be 3 to 5 times. A retail operation might be 5 to 20. It all depends on the industry and type of business. If the ratio is too low, with too few turns, this means the business has too much inventory and may have obsolete inventory, or that they are carrying poor management or false reporting. If the ratio is too high, meaning they have too many turns, this means there could be theft or maybe spoilage going on in the business. If your business has inventory, I would highly recommend you calculate your number of turns and compare it to the benchmark for your industry. Are you too high? Are you too low? Before you have a buyer looking at your business, you want to make sure to tighten up your inventory controls and reduce the chances of this being a secret they find in your tax returns. Another part of your balance sheet that could reveal a secret is your equity. Years ago, my business partner convinced me that the equity, net worth as it's also called, was negative, and that therefore the balance of the value of the business was 0. I would have to pay him to get out of the business. Now, I admit I didn't know any better, and I agreed to give him back a $16 million business doing $500,000 a year of net profit for nothing. I walked away and simply gave him the business. I did not know the truth. A business is not worth what the equity says. This is an accounting calculation, not a fair market saleable calculation. That mistake has cost me millions, and I hope by sharing it you can avoid this mistake as well. Negative equity simply means the seller has more liabilities than assets. This could mean that they've been taking out more money than the business makes, having financial challenges, faced a catastrophic event that might need to be explained, like a forced partner buyout, or has extremely fast growth or recent major equipment purchase. A buyer will want to know the details of the situation, and this could kill a deal if not properly explained. To prevent this from killing your deal, review your balance sheet with your accountant. Make sure it's accurate before filing your taxes each year. It's a good time to clean up the balance sheet. Often there are mistakes on the balance sheet that the buyer catches, and it leaves the seller scrambling to correct during due diligence. Ideally, you want to have your records as accurate as possible before the buyer sees them. Now, secret number 2 is, can your business be approved for the deal? Although it's easy to believe the buyer is the only decision maker for the purchase of a business, the truth is most buyers will be leveraging a third party to approve the purchase of your business. So when you look at the last 3 years of your tax returns, if you're reporting a very low or negative profit, this will set off huge red flags. And what most sellers tell me is, but when you add back the kids' salary who aren't working in the business, personal perks like dinner out, season tickets to the symphony, groceries, and my car and my other perks, the business is very profitable. And I can tell you from experience, in working with tons of buyers, this is all good and well as long as these 3 things hold true. 1 is you can adequately prove all these items and the buyer believes you. 2, the buyer has enough money to pay cash and does not require bank financing. Number 3, you're willing to be the bank when the case where the buyer does not have enough cash. Now, sadly, most buyers will not fall into this category. So let's talk about our 3 main types of buyers and why tax returns are critical to getting your deal approved. The 3 types of buyers are going to be a strategic buyer, a financial buyer, and a visa buyer. So let's go over them one by one. Now, the strategic buyer is our first type of buyer, and typically they're going to need approval of their board in order to be able to get this deal to happen. So strategic buyer is often a competitor or a person in the know in your industry. They know the benchmarks. They have a system for operating a business like yours. They'll know if the business is well run and if you have a tight operations. A well-run business could yield much higher price with this buyer. They enjoy working with organized businesses that are well structured. But in order to make the purchase, they're going to need to get deal approval from most likely their board, a banker, an accountant, and perhaps partners. For this buyer, clean books and records are going to matter. Now, the second type of buyer is a financial buyer, and they're buying a cash flow. In other words, a paycheck or a job. They usually want to see at least $75,000 or more of net profit. This allows them enough money to be able to buy the business, pay the debt, and be able to get a return on investment. This is by far the most common buyer that we work with. When buyers are looking to buy a business, they often don't want to use all their own cash. I mean, think about it for a minute. If you were buying a $500,000 business and had $500,000, would you use all your money? Or would you use $100,000 and get a loan for the other $400,000 and let the profit of the business pay for it? Most buyers are very savvy, having accumulated this much cash and savings. They're going to want to leverage OPM or other people's money. So in order for the buyer to get a loan on your business and get the business financed, the bank is going to require 3 to 5 years of tax returns for this business. In order to leverage the SBA loan, and SBA is very strict on the adjustments, the bank is going to require clean books and records. It's not enough just to say, oh really, honestly, I took the money out. It needs to show on the tax return for the SBA. Now, the third type of buyer is a visa buyer. And these are folks from other countries that are looking to buy a business as an investment in order to qualify to live here in the United States. Now, usually they look to spend somewhere between $100,000 and $1 million. They will pay a little more than the financial buyer because the business has to qualify for the visa. And in order to qualify for the visa, the business is going to have to employ at least 3 employees. It's going to have to show profitable tax returns. And the owner is going to have to accept being under contract for possibly 3 to 6 months before the buyer is granted permission from the embassy to buy the buy the business for the visa privileges. Now, because not all businesses qualify for a visa, when a visa buyer finds a business they like that will qualify, they're often willing to pay just a little bit more than the financial buyer who has many more options to choose from. Now, because the visa buyer needs approval from the embassy, this greatly depends on the tax return, clean books, and records are going to matter. So in the end, regardless of the type of buyer that ends up buying your business, the quality of your records will matter to them. It's best to keep only legitimate business expenses in your business so that there's no secrets for a buyer to find. The best way to avoid this secret from killing your deal or reducing the number of buyers that can purchase your business is to keep clean books and records, and by keeping personal perks off your business records and only including legitimate business expenses. Now, the third secret is how trustworthy are you? And in order for the buyer to spend their hard-earned money to buy your business, they need to have a certain level of confidence that the number that the seller provides are actually real and that they can make the type of money the seller claims. Sadly, buyers feel if the seller is willing to lie to the IRS under threats of perjury and imprisonment, the seller will also lie to a buyer. Now, I know this is strong language, but I want you to hear this. Consider if you're going to buy a car and you knew it had been in an accident, but the seller didn't tell you. Wouldn't you question what else they're not telling you? Your buyer is the same when they learn you've been shortcutting on your taxes. They wonder what other shortcuts you've been taking. Are the vendors not getting paid? Are you not paying your employees? Are you skimping on the quality of the product? Are they about to deal with a barrage of unhappy customers the day after closing? Their mind runs wild with what-if scenarios. And if you're willing to fudge your numbers to the IRS, the buyer will question everything you say. This means the buyer is starting off on a skeptical position, and you will have a long and rough due diligence process as the buyer tries to prove everything to reduce their risk, and this kills deals. When considering if it makes sense to keep your books clean, consider you can save 38 cents on every dollar by minimizing your net profit and loading up your books. Or you can make, on average, $2.50 on every dollar you keep in your net profit. Now, here's why I say this. Your tax returns could be as high as a savings of 38 cents on each dollar you hide. Or it is the tax return of the buyer that you keep, you get $2.50 for every dollar showing on your net profit. Simple math says it's better to keep it on the return and let the buyer pay more. Now hear me loud and clear. I do not endorse tax evasion. I want to make that loud and clear. My buyers will love you 10 times more if they can see every dollar you made and every honest dollar you spent in running that business. So I'm just going to share with you. Keep all of the profit and the income and the expenses to create the net profit on your tax returns. To protect yourself from your tax returns making your buyer doubt what your reportings are and if they're accurate, just keep accurate books and records. In the long run, not only do you make a lot more money, you earn their trust, which is much more valuable in the end. So here are the 3 secrets that we walked through today. We walked through how successful the business is, the ability to get the deal approved, and your trustworthiness. But if we bounce back to Tom, had he known about these secrets, he could have saved his deal and made significantly more when he sold the business. The last thing Tom could have done was to have, the best thing Tom could have done was to have the right business broker guiding him that already knew what to look for, that experienced selling businesses. Of course, with enough time, Tom could have learned how to sell a business. The challenge is he ran out of time. And experience can go a long way when dealing with a one-time event. There are many places to get information. That is often free. But experience is expensive because it costs years and years and years to accumulate. A good business broker will make you more than you ever spend on that broker and reduce your stress and keep the deal confidential. Now, when you're looking to sell your business, here's some things to look for when selecting a business broker to work with. First, look for a trained professional that's educated in selling businesses, not just a part-time person looking to make extra money on the side. Ideally, they should have extensive training and hold a board-certified intermediary certification and be actively taking classes to educate themselves. They should not just be someone that has a real estate license. No 2 deals are ever the same, and because of this, when selling a business, it's critical to have someone with vast experience in selling businesses. Number 2 is look for a thought leader, someone that's watching trends, someone that can give you the best advice. Are they really paying attention to what's going on, or are they just going through the day-to-day operations and not there to really guide you? Second, they should complete a full analysis of financials and look deep into the business to determine the selling price and find out what the market's going to support. They need to see the secrets before the buyers see them. Next, they should have an extensive written marketing plan that includes many strategies to attract the best buyer so you don't have to settle due to lack of interest. This strategy should include targeting both individual buyers and small business buyers, which are 2 very different approaches if your business is a good fit for this. Next, they should be actively leading the buyer through the process. This means understanding their needs, finding the best business for them, guiding them through the evaluation, recommending lending, packaging the buyer, attending all meetings. They should leave nothing to chance when it comes to the sale of your business. And lastly, they should have a higher than a 50% selling ratio. You want to make sure they actually sell businesses, not just list them. They say the national average is less than 20% of the businesses that get listed get sold. At Murphy Business and Financial Services of North Florida, we offer our sellers all of this and more. We are truly vested in selling your business, not just listing it. We do what it takes and go above and beyond. Just check out our reviews on Google. At this point, we're going to take just a moment and see what questions we have that have come in and see if we can answer any questions. So if you do have any questions and anything that you'd like to learn a little bit more about, please go ahead and type this in at this point. We'll go ahead and just give a short minute. We don't have any questions at this moment, so I'm going to go ahead and just wait 10 seconds more, and then we're going to go ahead and wrap up. Looks like we don't have any questions at this time, so I appreciate everybody attending. As we get ready to wrap up here, if you're thinking about selling your business now or in the future, give us a call. We offer complimentary consultations to help you prepare for the sale of your biggest asset. If you have any questions, feel free to call us or email us for more information. Our email address is jacksbizbroker@murphybusiness.com. Thank you again, and feel free to share this with anyone you know that might be looking to buy or sell a business. We exist to keep the American dream alive, one business at a time. Have a great week.